Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10 FX strategy here at NatWest, sitting in the U.S., and I'll be your host today. I'm happy to be joined once again by Paul Robson, who co-heads G10 FX strategy with me over in London, talk about all things major economies and major FX. A lot of data this week, certainly some interesting developments here in the U.S. as well as we think about the next Fed Chair. And to break it all down with me, I'm very happy to have Paul joining. So, Paul, thanks very much.
Well, thanks, Brian, for the invitation. I was personally hoping for a nice, quiet summer, but you've just gone through a whole list of, I think, very important market drivers. It doesn't feel like either of us are going to get much rest through the summer, but at least that will make it go quickly enough.
Yeah, absolutely. I mean, this has certainly been an interesting few weeks here. And I mean, I do want to start with sterling. And I know a big focus has been on the labor market in the UK. I know this was something that you wrote about in our weekly last week, Paul, this possibility that the UK labor market data comes out and tells us maybe a different story than what we've been seeing from more recent data. So how are you feeling about the UK data this week?
Yeah, so it was definitely an important set of data. And I think those labor market data, like you've just talked about, I think just changed the market narrative. So it's definitely worth taking a little time to run through those numbers. In terms of inflation, it was the same old story, just sticky inflation in the UK. There's lots of people who are sort of hoping that inflation comes down quickly and the Bank of England cuts more aggressively and more and deeper the market's price, but there really wasn't anything in the inflation numbers, both core and services. For the employment numbers, it was always going to be about the revisions to the May number. It's a bit strange because we don't really wait for data to be revised, but I think it was always clear that the outsized fall that we had in May, 109,000 jobs. If I put that into US payroll numbers, money, that's like suddenly getting a 400, 500 drop in payrolls. So it is an important size drop, and that was actually largely revised away. We still had 25,000 job losses in those May numbers. The June number had a slightly bigger fall, so 40-odd thousand. But there were also back revisions to the April numbers, and actually quite a sizable different sort of trend in UK labour market, which I think is definitely important. And when I look at some of the survey numbers, so the DMP numbers, the REC numbers, and I sort of put those together, and it suggests we might actually get some more positive data revisions in coming months. So that's definitely something I'll be watching very carefully. In the sort of totality, I think for the labour market is softening. Unfortunately, there are job losses occurring. I think that's the weight of tighter monetary policy, and I think also reflects margin pressure as well. Companies have seen wage increases. They've also seen the national insurance contribution increase, and I think they're struggling to pass that on. And if they want to maintain and seek to maintain margins, then unfortunately they have to look to reduce costs, and labour is a large part of that, and that was shown out in these numbers as well. But crucially, it's not happening quickly enough, I think, for the Bank of England to really revisit the sort of gradual easing in monetary policy that the formal guidance suggests.
Yeah, and I think you just leaned right into where I was going to go next, which was to the front end of the UK curve and specifically the Bank of England. You kind of hinted there, but how are you thinking about the Bank of England policy outlook here? Are these numbers really changing things for you? And maybe just as important, do you think they're changing things for the market?
Well, I think it's the latter. I think the labour market numbers do change market thinking. I think markets are priced for or looking for a sharper easing in monetary policy in the UK, and there's very little in either of these significant data reports this week to justify that position. They do, however, lean support to the NatWest base case for the Bank of England that we get quarter point cuts in August and in November, and then the Bank of England's probably done. Now, the labour market was to show renewed weakness. then maybe the Bank of England takes rates a little bit lower, a little bit lower rather than more quickly, I think, but nothing really changed. Terminal rate pricing, 375 in the UK markets, see it at 340. It's not a big difference, but I don't think there's very much scope for markets to price in a lower terminal rate here. And I think in terms of market positioning, as I say, I think bullish front-end rates might be pressured. And I think for the currency, I'm sure that's going to be the next question, I think that it leans slightly positive.
Yeah, I do want to dig in a little bit more on the currency because I know you've talked a lot about short-term rate differentials and monetary policy being a driver, but also long-term drivers, not just in local markets, but also in global markets, pressures from global markets in the long end of the interest rate curve. How are you putting all this together for sterling here, especially as I look at euro sterling kind of close to the top end of the range here?
Yeah, it sort of full disclosure, sterling has been weaker than I had expected, both against the dollar and the euro. I mean, we are in summer markets. It may well be position led. I'd be interested to hear your thoughts later on the podcast about what you're thinking about the dollar in these markets, given the news flow that we're having. But generally, sterling weaker, and that sort of cautious Bank of England outlook hasn't provided more support. I do think the data are important in the outlook for sterling because I think people have positioned for the Bank of England to cut more aggressively, and the other side of that is for sterling to weaken, and maybe it's a easier, cleaner trade to be short sterling against the euro because the ECB looks to have finished cutting rates. There's also been this fiscal policy angle to sterling, a greater fiscal policy risk premium. We had a vol episode a couple of weeks ago around the reform bill and worries about the change to the fiscal rule, if that was something that the Chancellor would look at later on in the year. But I think there's a little bit of excess pessimism. I'm not saying that the fiscal outlook here in the UK is very positive and well positioned. It's still unsustainable, we think, but that comes later. I don't think we need to price in significant tax hikes come the autumn that weakens the economy, that leads to monetary policy response for the Bank of England to lower rates more aggressively. This can be done via personal allowance changes. There can be like backdated spending shifts that the government hopes not to actually get to. This was very much the way the former government, especially under Cameron and Osborne, where you always seem to get this tightening of fiscal policy at some point over the cycle, and you never really got there. So, if I'm right and fiscal policy risks are exaggerated, if I'm right that this data that we've had this week makes it less likely the Bank of England cuts rates aggressively, and I think there's scope for sterling to recover both against the euro and the dollar.
I find it really interesting as I think about global long end pressures, and you think about some currencies seem to very clearly price weakness related to those pressures, while others may be a little bit more insulated from that. It seems sterling is one of the ones where the markets are very happy to reflect pressure from the long end into the currency. More recently, Japan has been in that camp as well as we look ahead to upper house elections there. Euro and the dollar, maybe not as much, even though in some cases you have seen these global moves higher and long end yields have been. You've really seen it cross market. So I find that really interesting that in some cases you've seen that sensitivity in FX markets, and in others it really hasn't been the same story. I do want to turn over to the euro now, and as we look ahead to the ECB, is there anything we should be expecting here in terms of something that could be really material for the currency?
No, I don't think for the ECB will be market moving. Markets haven't got any price in. We totally agree. The ECB leadership, Lagarde, has been very clear. See you after the summer, suggesting that this isn't going to be a market moving event. There's not been a lot in terms of the data. Inflation's at 2%. Inflation expectations are anchored at 2%. Inflation's expected to be 2% in 2 years' time. So it's very much wait and see for the central bank. And of course, you've got this tariff uncertainty. And we're still waiting for any kind of trade deal between the US and the European Union. And definitely that's something to watch. And also the outlook for the euro area maybe has hit a bottom and maybe a surprise to the upside in terms of fiscal policy. There was some speakers over the last couple of weeks suggest that inflation's been low because of energy prices, but that won't have a persistent impact. So I think the ECB thinks that their job is done. Markets are pricing in an additional 25 basis points of easing by the end of the year, but that's more about a sort of September decision, December decision. But for this week, unfortunately, I don't think we get much that's interesting for currency markets from the ECB.
And I think that makes sense as well, because it feels like that September, December potential cut, potential not, feels like it's so tied to what happens with the U.S. and the potential trade talks as we head into this new August 1st deadline. I do want to ask you a little bit about the currency as well. It feels like, with a number of dollar-based pairs, including euro dollar, we've seen a bit of dollar strength. That feels more like a dollar story than it does like a euro story. But I did want to get your sense of what are you thinking on the currency here as specific to euro?
Yeah, like you say, it feels very much like a dollar recovery story that's pushed euro dollar lower. I still think we'll be close to 120 by the end of the year. But I think for the currency, it's been really interesting to see how the European currencies have performed over the last couple of weeks. And there's very much a safe haven bias here. So the euro has done well. The Swiss franc has also done well. But Scandinavian currencies that tend to be more sensitive to how confident international investors are about the outlook. So the Swedish krona and the Norwegian krona underperforming over the last week, and sterling's in the middle, which I think, as we've just talked about, there's been some other cross currents that's been driving the currency. So that safe haven bit. It feels like a little bit of lightening up on positions ahead of the summer holidays, people taking chips off the table. It has been an uncertain outlook. It feels like Donald Trump's gone a little bit harder at tariffs than markets expected. I'd be interested to hear what you're thinking about that and crucially what's going to happen. But if we do get escalation in tariffs through the rest of the year, I do think that's generally supportive of the euro. So, I'm always loath to change market calls during summer thin markets. The same with sterling. If the facts change, I will revisit that. The same with the euro. I don't think the facts have changed at the moment, and therefore happy to lean against any further weakness in euro dollar. So I've mentioned a couple of references to the US and Trump there. It's certainly definitely been market moving. We had the recovery in the dollar. We also had some very important inflation numbers this week. Just wondering what you're thinking about how that plays into the dollar outlook and crucially what it might mean for the Fed.
Yeah, I think you sort of alluded to it as well. I feel like the big question for the dollar has been, we've had a bit of a recovery here. Is this more of a positioning move? The market is clearly short of dollars. This is a positioning move, lightening up of positions in otherwise, I don't want to say quiet markets, but certainly thinner liquidity markets as we are in the summer period. Or if this is the start of a rethink of some of the longer term themes of shifts in dollar dominance and changes in dollar, say, reserve currency status, changes in hedging behavior. And I agree with you, Paul. I lean towards this being more of a positioning reset, if you will, rather than necessarily a change in the longer term outlook for the dollar, which I think still points to the downside. But the data we got this week continue to point to a bit of almost a frustrating picture for, whether it be dollar bears or dollar bulls, if we're being honest. It feels like the economy is in a bit of a holding pattern where we have some signs of slowdown relative to the very strong pace of growth that we've become accustomed to in previous years. But at the same time, we have not really gotten to this cliff's edge point that I think the consensus at one point had really been expecting. I mean, you clearly see some slowdown in the labor market and in some categories of data. You've seen some of the pullback that's been expected because of the front loading, the pre-loading ahead of tariffs. In the first quarter, that boosted a lot of that data. Since you've seen some pullback. But, we've had a couple of important data prints this week, with the inflation numbers being the most important, because as we know, the Federal Reserve is waiting for evidence of inflation from tariffs before considering its next move. There's a camp on the Fed that thinks services inflation is going to continue to fall because the labor market is in balance, and that labor market being in balance means that wages are unlikely to be putting upward pressure on services prices. Those individuals, Waller and Bowman, probably the most famous or infamous among them at the moment, want to be moving toward cutting sooner. There's others who think we should be waiting and seeing because within core goods prices especially, you're going to start to see those tariff impacts hitting over the summer, starting with this print. And it feels very Jekyll and Hyde within the data, right? That there's a good narrative on inflation and there's a less good narrative on inflation. And I think both sides got something to grab onto in these inflation numbers. The services numbers within the CPI and the PPI were, I think, continue to be encouraging. But it's on the good side where we did start to see, I think, clearer evidence of tariff-linked inflation. So within the CPI especially, some of the categories of core goods that are import sensitive were among the categories where we saw the largest upside gains. Now, if you were to, used car prices fell pretty sharply, and that lowered within the CPI, I should say, and that lowered the overall hit from goods prices in terms of higher inflation. But if you removed used vehicle prices, this was among the strongest gains for core goods prices since 2022. So for those on the Fed who are expecting the tariff gains to find their way into inflation, they saw evidence of that this week. For those who are expecting services disinflation or slower services inflation to continue to point towards lower inflation independent of tariffs, I think there was some evidence there too. All of this taken together, I don't think we really changed the Fed view all that materially. Still feel like July off the table in terms of a move, maybe disappointment to the president there. But it seems like July is still going to be in wait and see mode. There's enough in these numbers to keep September alive. There's enough in these numbers to make you think we're less likely. But I mean, all of this together, Paul, you have a market where we're coming into these numbers with the market generally short of dollars. It's still expensive from a carry perspective to hold those positions. And if the data aren't really reinforcing that story, especially in these thinner liquidity months, maybe that encourages some moving to the sidelines. I think that's what we've seen here.
Yeah, that's all very clear. It's interesting, isn't it? I was struck by how the data on both sides of the Atlantic this week were just sort of testing that market consensus. You mentioned inflation. We obviously had inflation in the UK and also sort of data resilience and some resilience in retail sales as well. The other thing that was moving the dollar, it seemed, if not just very sort of temporarily, was this sort of speculation about Trump and whether he would fire Powell. I did wonder about sort of recollections seem to differ between various people in the White House, various letters, and then obviously renovations of the Fed. I don't think anyone's ever done renovations of their own house or that haven't massively overrun. So I do have some sympathy there. But so what are you thinking there in terms of Trump and Powell?
So I think, the sort of mechanics of removing the Fed chair or the lack of ability to remove the Fed chair have been pretty well socialized at this point. But just to run through them briefly, the Fed chair can only be fired for cause. That's written pretty clearly into the Federal Reserve Act. There's some pessimistic views in the market, and I think it's fair to say that there's some reality under this as well, that the story about Fed renovations is effectively the administration trying to sort of create that cause, if you will. But I think there are limits bureaucratically and also in markets to making a move on Powell. And I think we got a preview of what the market reaction could look like in the event that Trump were to move on Powell. In the brief, call it hour or so, when that speculation really ramped up in the media before Trump essentially pushed back on that speculation. And what we saw was a sort of return to the sell America style dynamic, where you saw weaker dollar across the board, lower equity markets, and also steeper interest rate curve, certainly lower interest rates in the front end, as the markets assumed that this move would be specifically to put in a Fed chair who would enforce a more dovish policy in the front end, but also higher interest rates in the long end. And I feel like markets are what will ultimately be the enforcement factor for Trump, whether it be on Powell or on tariffs or on fiscal policy. We saw that during the Liberation Day period when significant volatility in long-end interest rates, higher long-end interest rates, combined with lower equities, I think in hindsight ultimately forced Trump's hand in terms of allowing for the 90-day delay. And so I think we saw a mini preview of what markets could react, how markets could react if Trump were to make a move on Powell, he were to try and make a move on Powell. And if that were to be the direction of travel, it's maybe a warning from markets to the president not to make this move. And I think that warning has been heard. Now, there are other options that Trump could consider. There's the question of a shadow Fed chair option. There's other options, demotion of the Fed chair that Trump could consider trying to go down that road. All of them kind of point in the same direction of moving on Powell early would be something that creates a market dynamic that I think the president is going to be wanting to avoid, especially with equities having recovered so well from their mid-April doldrums, if you will. So for the dollar, I think this is one of those risks that there's kind of two things to say about it. Number one, it may not be here right now, but there is still a small chance of a significant dollar move that could come if Trump were to try and go down this road that I think markets do have to keep in the back of their mind as we consider the outlook here. Certainly, we've had a bounce back here in the dollar, but markets probably have to consider the small risk of an outsized dollar weakening move if Trump were to go down this road. That's probably point number one. Point number two is that this might not be a story today, but it will be a story in 2026. Powell's term as Fed chair does run out in May of 2026. And so even if we're not necessarily going to be, collectively as a market dealing with the questions around the next Fed chair, their relationship with the president, the future of Fed independence, those might not be questions in July, August, September of 2025, but they will have to be questions in March, April, May of 2026, because Trump will have the opportunity to pick a next Fed chair on what we would call, I guess, regular order.
Yeah, it definitely feels like markets gave their verdict on it. It's very much like the vol event in gilts markets, the vote of confidence or not, and where the red lines are, and certainly the long end move. It certainly seems to have been the interesting move around that. But like you say, equity markets on the highs. You've got a budget bill, kind of win in the Middle East. He's probably feeling that he can push it a little bit further, but that's definitely an area to watch. And then finally, we never seem to get through one of these podcasts without mentioning US trade policy and tariffs. We continue to get more information. The deadline shifted to August 1st. Just thinking about what your latest thoughts are in terms of US international trade policy.
Yeah, we've got a few weeks before any decisions have to be made, but of course the markets have to take each deadline seriously. Trump has a bit, there's some deadlines, April 2nd proved to be a deadline that significant new action was taken. Markets moved dramatically and that forced a change of tack from the president. But there are other deadlines, such as in early February and also the July 9th deadline, where we just saw the president set a deadline for July 9th that he moved by a few weeks. So there's no reason to think that August 1st is any more likely or less likely to be the sort of drop dead date for tariff implementation than any of the other deadlines that we've had. Maybe the biggest difference, as you said, Paul, is that Trump is on a bit of a personal winning streak with the big, beautiful bill in hand. His focus on fiscal policy has clearly fallen now that the tax bill is in hand. He clearly feels pretty comfortable with the state of the economy, the state of the market, and seems more willing to be pushing down this road. So I think markets do have to consider that as a possibility. The other one to think about as well is the intersection between these tariffs for August 1st and also the universal minimum tariff and Trump's recent overtures about potentially increasing the 10% universal minimum tariff. Because if you remember, in April, most and all of the delays came in the reciprocal regime, which were the independent levels for different countries. But the universal minimum tariff stayed in place, and that was implemented, and all of the volatility around trade policy was around the reciprocal regime. We could be looking at something very similar for August, because Trump seems to be floating the idea of increasing the universal minimum tariff rate, say from 10% to 15%. at the same time as he's promising these significantly higher tariffs on global trading partners. So if you think about what happened on April 2nd, he sort of snuck a universal minimum in behind a massively volatile period around these reciprocal tariffs where they were initially put in place and then ultimately delayed. I think it's possible we're looking at something similar now, where maybe the reciprocal tariffs that have been announced for August 1st, maybe there's further room for delay there. But if Trump is also serious about maybe increasing the universal minimum tariff, those have proven stickier and maybe something that's maybe less room for negotiation. So maybe a similar playbook to April 2nd coming up, maybe not as much in markets as in implementation risk, where Trump might be looking at trying to increase maybe these minimums by a relatively modest amount while being more flexible on the specifics of the reciprocal regime by August 1st. So a lot of uncertainty as always, but certainly interesting to hear Trump talking about the two different levers of policy, the reciprocal versus the universal minimum. That, to me, I think is something that we should be watching as we approach these deadlines. But, 2 weeks between now and that deadline is basically an eternity for trade policy in the modern era. And so there's plenty of time for things to change. And, I'm sure we'll be talking about this again in the coming weeks, Paul. So and stay tuned for more on U.S. trade policy as all of this develops. So we've covered a lot of ground, Paul, and I think we should probably end it there. So thanks very much for joining. Really great conversation as always. And to our listeners, thanks for listening to today's episode. If you enjoyed the podcast, as always, please consider giving it a like and also subscribing to the channel so you can get our latest podcasts once they're released. Thank you very much.